Hi everyone, Michael McVitie, President of Red Fortress, with you here again today. Wanted to do another video on a great luncheon I attended. It was from somebody who works out of the Miami branch of the Federal Reserve, the actual Federal Reserve in Atlanta, and she's the regional executive. And so I wanted to pass on some notes to you about what the Federal Reserve had to say about the area, the economy, that sort of thing. So without further ado, let me just share my screen and we will start. Okay, hopefully you can see that. So again, I just want to go over a review of the Federal Reserve Luncheon. And this is just a little bit about 2 weeks since I did my 2025 predictions for rentals and real estate market in Southwest Florida. That, Cape Coral, Fort Myers, Naples, Port Charlotte area. And there's four main topics that I want to discuss with you today. The first is discretionary income for renters. The second is the jobs and economic data they provided. And these two first points are really important because I did a video back in September of 2024, so about 4 months ago, about the importance of the income of our renters and also the employment levels and how that factors into basically what rental rates are in the area. So those are really two key components. If renters have more discretionary income to spend, and if people have jobs, that has a tendency to obviously lift up the rental rates in the area outside of the normal supply and demand, obviously. Then the third aspect we're going to talk about is the interest rates and how they affect real estate. They had an interesting particular observation in Naples that I'll bring up. And then the fourth aspect or topic was I predicted certain trends in 2025. How do I feel after hearing what Sherry had to say from the Federal Reserve Bank in Atlanta? So without further ado, let's do part number one. So discretionary income for consumers and renters. So first of all, they felt very, very good about the spending. As you can see, let me see if I can't annotate this a little bit more. You can see that they felt very, very good in, September, October, and November. So they felt that the increase in spending is good. There was a strong demand. Interesting, had a lot to do with vehicles and vehicle parts and so forth. And it's interesting that when you looked at food and beverage and so forth, that was actually on the negative. So with inflation kind of being almost a little bit lower. I mean, it's not like the prices are going down, which is a very, very important point. It's just that the prices are not increasing as fast. It's interesting that I'll come back to this negative 0.2 for food, and that is symptomatic of what they've been looking at. So again, they felt very, very good. One of the reasons why they felt very, very good is because, as it says here, the stock market was up. That means that there's more wealth in the households. That means that they can invest in cars and that sort of thing. It affects the GDP. And they also were pointing out that they felt that the real wage growth of people was, kind of doing relatively well at about 2%. Okay. So what's interesting is that they were saying, hey, things are good. Go back to the last slide here. Things are good. They're starting to spend a bit more month over month, 1% on goods. The stock market is up. The 2%, real wage growth is good. But like anything, I'm always looking at, is this sustainable? Okay, so like a rental rate, it's great that we can increase the rental rate, say 10% year over year. But my question is always is, well, wait, are the people actually making 10% more each year? Because if they are not, then obviously it's not sustainable and we're going to have some type of downturn, a reduction in the rental rate. So this is where it gets very, very interesting in the next couple of slides for sure. So they talk about how Sherry was saying the Federal Reserve was observing in our area that the savings are down, like in Southeast United States overall, that they're looking at it being basically 4%. And they say in their own slide, these are their slides, this personal savings rate is below pre-COVID levels. Now, here's where COVID is. That's where they were handing out money for people to stay at home type of stuff. Over at 12%. So the savings went through the roof, and then you can see it kind of crash as people started to go back to work, spend money, and now it's kind of gone up and down. You look back over here, this is where we had the recession or in our area, the depression in real estate. Okay, that's where the banking crisis and that, where people weren't saving, very little money, 2 to 4%. Well, we're only at 4% right now. So they're saying the savings are down. And remember that point I was saying to you about how the food, like people weren't spending as much, they were spending more on cars and car parts and that sort of thing, but not as much on food. Well, that's what she said was interesting because she talked to an economist and he was calling this a no dessert recession or a no alcohol recession, meaning that when people were going out, they were kind of trimming their bills. They weren't getting a dessert after dinner. They're not ordering as much alcohol. So, as we were saying, and we've talked about in the previous video, she was saying specifically that low income earners are pulling back. They're not spending as much money. And you're going to see why in a second here. And it's evident. So the next one, they're talking about the mortgage, auto, and credit debt is up since 2019. Now, I talked about this back in September of 2024 when I was talking about the car debt and so forth. So here, you can see that the student loan is still, sitting in fairly high. Okay, we'll get to that in a second. The auto loan is going up over time. You can see it right here. It's increasing. Same thing with the credit card debt. Okay, so they were talking about how the credit card debt is up 8.1% from a year ago. Okay, the car loans are up, so that's not very good when you're having all this massive amount of debt creeping up into people. Okay, yeah, people's budgets, that is. And here's something very, very interesting. They're talking about the percent of balance, 90%, 90 days plus delinquencies. So they were mentioning that the credit cards, the debt is now over 10% where they are delinquent 90 days plus. So the credit card debt, as you can see, in the last 2 years has started to creep up where people are becoming more delinquent. You're seeing other debts also going up. You're seeing that the auto loans are kind of starting to creep up a little bit. What's interesting is that the student loan crashed. I think that had to do with federal governments trying to waive restrictions and telling people not to pay their loans or loan forgiveness and all this other stuff. So again, this isn't very, very good when we're talking about the discretionary side of things. That first part of the equation, do people have more money? Well, you're starting to see it. There's starting to be more and more credit card deficits and delinquencies on it. You're also seeing student loans and other aspects of debt overall are going up. Okay, so that's part one. Part two now, I'm going to talk about the jobs and employment. So, what was interesting about this talk was they were talking about how they were trying to balance with the interest rates. We're coming up in part three for that, but that they're well aware of the inflationary rate, but they also understand that what they do has an effect on the economy. And what they were initially talking about was in this graph here was that after COVID, there was, according to them, a huge supply for workers, and they didn't have enough workers here um, to meet the demand of employment. But then all of a sudden, you can see that the demand for people exceeds the supply. Okay. And this is becoming closer and closer and closer to the point now where the demand and supply for jobs are almost parallel. Okay. And this is again labor, unemployment, and unemployed, that sort of thing. So it's really leveled out. Okay. When we're talking about do we have enough workers for the jobs, that sort of stuff. Okay. Now, here in the next slide, they're talking about the good employment growth. What was fascinating was that they felt that there weren't a lot of government jobs being created. It was more so private sector, and she went out of her way to point out that there was a lot in healthcare. Excuse me, let me go back there. Didn't mean to do that. So there was a lot in healthcare. Um, this is also outside of government and healthcare. So that was also a decent last month in November. That's when she had the last economic data. Okay. And what was fascinating about this was that when we were talking about the job cycle, she brought up the fact that people are not leaving their jobs as much now. So she talked about the people staying put at their current positions, that their quit rate was down. You can see it starting to go down after COVID. 3.2%, kind of like the high was there, 3.3, where people were leaving their jobs, and now it's steadily a trick down to about 2.3. And what's interesting is that she was saying that the wage growth is about 4%. right now. She said that's good, or at least she felt that was good. Interesting, she said that the number of months it takes for somebody now when they leave a job to find a new job is 6 months now, up from 5 months. So now she's talking a little bit more about the job market, the job security market. Now, what's interesting is that she mentioned the 4% wage growth, but how does that compare to inflation? But also remember that most of the time when they do inflation and they you hear 2.9%, that does not include food and gas. We'll get to that shortly. So one of the things that she mentioned here, last part in part two, is she was talking about more steady unemployment. And this is what she was talking about here. Is a really interesting graph. I didn't even know they tracked this, but they were talking about people that switch jobs a 3 month period over time versus people staying at their job. This is the lower graph here in terms of what they were making. So more normally people would leave a job, okay, for more money. And they were saying back in 2022, that was definitely the case. People were leaving, say, a couple of years after COVID, and they were making, say, more money. And now they're saying that that's not the case. So not only is it harder for people if they leave a job to find a job, but now they're saying that when they leave that existing job, it's not necessarily economically more beneficial for them, according to what they're getting from the Bureau of Labor, their statistics. Okay, so that's part two. Part three, we're going to talk now about inflation. We're going to talk about interest rates, and we're going to talk about real estate and what's happening here. So they they like to talk a lot about this term called sticky inflation. Okay, and they mention this repeatedly. You've probably heard it on other economic talks. What they're talking about here is how they want to have that 2% inflation. And they're talking about the core PCE, the consumer index, basically, okay, like prices for consumer. But keep in mind the core that they talk about does not include food and does not include gas. So that's fine if you never eat. But maybe one of the reasons why they do that is because sometimes like the prices of gases are escalating a lot. They're not really stable. So maybe that's one of the reasons why they look at this. Maybe some people suggest that, the stats that they're looking at, the inflation rate would obviously be much higher if you include it in fuel and food costs, which is where most people are obviously affected by this sort of thing. But they're trying to keep it at 2%, like you may or may not already know. They talk about a 5 year average of being, say, most recent, it's been more like below 4%. Okay. And then they're talking about what's actually been happening over the span of a year. And they're trying to get this down to around 2%. Okay. So they say the good news is that the inflation is starting to recede. But the problem is, as they said, it remains sticky by any measure. So when they were comparing November of 2023 to November of 2024, in every single metric, it went down from 4 to 3, 3.35 to 3.9. You can see all the numbers here. They're always going down. So they're happy about that. But they want to hit 2%. So every single metric is harder than they want. And these metrics, you can look at them. They have all different terms for it: Atlanta, Dallas, San Francisco. They're looking at all these various things and they're saying, listen, we're not yet where we want to be in terms of controlling inflation. So it's better, but we're a little bit uncertain. Okay, so they say that it's going down. It's not where they wanted to be. So what she was saying is that they had a plan, but they've had to revise that plan for 2025. And this is another really interesting graph. So they're talking about how the current interest rate is 4.5%, and they're talking about how it might go down to 4% by 2026. And here's what's interesting. In September, they projected this line, so much steeper interest rate declines. Now, their latest progression or projection, I should say, is much less cutting. In fact, the inflation rate in September was 2.1. In December, it was 2.5. And January just came out, it was 2.9. So once again, the inflation is not behaving. It's sticky, as they call it. It won't go down. And what she was saying is, instead of having four changes in rates that they were thinking initially in 2025, they're thinking of only having two rate changes in 2025. Okay. So once again, that means that things are they're kind of not where they want it to be. They're being a lot more cautious. They're not really certain what's going to happen with the economy. It's not like they're expecting, huge swings one way or the other. That's a subject for like a different topic with regards to, Congress and the presidential, agendas and how it might affect things. But they talked about that, and they said that we're not really interested in. They're interested in fiscal policy, not necessarily. I'm sorry, monetary policy. They're interested in this sort of stuff, not fiscal policy, what the Congress and the president might do. So, so you see those projections. This is really, really interesting. They did a local um, look in real estate, and they compared it to the Naples Marco Island area. What they were saying is basically that the actual median household in this household in this area is 91,000. They were saying that basically to qualify for those homes in the area, it's 188, or double. As I say here, 105.8% is the gap between qualified and actual income. So what they're saying is real estate prices for people to buy in the Naples Marco area is really high, and it's twice as much than most people can afford. They say basically 30% of the people can afford the home if they're actually only living in the Naples Marco island area, right? So 30% of the people can afford it. Otherwise, obviously, people could come from outside the area and buy, right? But they're saying the actual natives, only 30% of the people can afford the homes in that area. So that was interesting. You see the graphs here. And here's another one that they were talking about, which was, just again, in the 30-year fixed rate mortgage average, they're saying is 6.72, or almost 6 3/4 in December. Okay, they're saying the federal rate in December last month was 4.5, basically, and they were talking about how there is a correlation between what the Fed's doing and the 30-year fixed mortgage. But, and this is a topic for a different video, but it doesn't necessarily mean that because the Federal Reserve decides to lower their interest rates to banks by an eighth an eighth of a percentage or a quarter percentage, it doesn't automatically translate, as you can see here, into 30-year rate mortgages. And why is that important? Well, for people that have ARMs, say renters or our clients, if you have a second mortgage on a property, you want that 30-year mortgage rate to go down. There's no doubt, because it's going to mean that whatever your debt is, it's going to go down automatically without you doing anything different, right? So this is really, really important. And what they're saying is that so many of these factors like inflation is really, really important when they're trying to decide where they're going with the rate, but also how it's affecting this 30-year mortgage, because people want certainty in terms of treasury bills, 10 years, and that you can't just all of a sudden raise up the rates or lower the rates and it automatically affects the lending rate for private banks, and the 30-year mortgage is the point, okay, generally speaking. So it's good when they lower the rates, but it doesn't automatically translate to a lowering of 30-year mortgages. So say, for instance, you can refi your property. So they are well aware, as she said, of the inflation. They're well aware of the effects of the economy. What she said was is that, in generally speaking, when you're uncertain of how things are going, you're going to go slow. That's why they're going from a prediction of 4 rate cuts in 2025 to only two. Now, this is really interesting. Somebody asked, well, basically, with more defaults, how are they handling these defaults on credit cards, say real estate, that sort of stuff? Because obviously a lot of people in the audience remember how it was in 2006, 7, and 8 here and throughout the United States. And what Sherry had to say was that the banks are restructuring deals, that they're not pulling the rug out from underneath people. If people are having some issues, they're starting to restructure deals this way. She said there's no overall sense of concern or panic about debt levels or anything else like that. They're just saying, hey, we got it. Let's restructure the deal and, try to avoid all these defaults. Okay. So that's area 3. So the last one, the final one, part 4, how, after listening to Sherry and what the Federal Reserve numbers are, how did this affect what I predicted a couple of weeks ago for 2025. So, first of all, I said that the rents were going to remain flat at the lower levels because people didn't have discretionary income, and it would drop further on the high-end rentals in 2025 due to inventory coming on the market for the multifamily, as well as a lack of sales. And when people can't sell their home, they might consider renting it out. And basically, she confirmed that, or the Fed data confirmed that. The defaults are growing, and the savings, I use the term tepid, meaning that people are not having a lot of ability to save right now. I think that their overall spending is being used on things they're already spending money on, and they just don't have a lot of money to be able to save. So defaults are growing, and savings is very, very small, like they pointed out. Insurance costs, I predicted would rise slightly this year. But we should see some relief in 2 years. Obviously, the Fed didn't comment on hurricanes, so no change there. Flood insurance will stay high, I said, which is affecting landlords, obviously, in sales with the flood insurance. I don't know. Maybe after this talk, maybe these rates might go a little bit higher. So, in other words, if real estate is increasing with this inflation and they can't control it, and the rates are not going to go down, the interest rates that is, maybe that could still keep that flood insurance high, like I predicted, or even higher. Okay. Property taxes, I said, would go down next year for the tax year of 2025, meaning, what are the bills going to be like for 2026 when you can pay it in about 10 months. Right. And they confirmed it, just like that slide showed you about Naples and Marco Island. It's not easy for people to buy. They don't have a lot of savings. And obviously, the locals don't have the money to purchase it. So the sales price will continue to slide. And I said that 2025 and 2026 will be a good time to buy investment properties because they'll be cheaper. But what you have to do is remember that the rental rates will eventually catch up in a couple of years because of this. They basically confirm that. So if you have any questions or comments on this video, please let me know. Again, I'm Michael McVitie, president of Red Fortress Property Management. I hope this is going to help you just learn about our market, help you better invest, because we certainly want people to invest wisely in our area. Again, you can call me at this number, 239-939-1233, extension 306, or send me an email, mike@redfortresspm.com, mike@redfortresspm, that's short for propertymanagement.com. Like I said, I hope you learned a lot in this video. You can use the information. I really enjoyed the luncheon. I appreciate it. And we'll see you guys next time. Take care.